Hello, greetings, and welcome to Dividend Blasters. This is our 50th video. Our topic today is you can turn $5,000 initial investment into $1 million with this simple strategy that I'm sharing with you. Before we start, a couple of house cleaning items. First, a disclaimer. I am not your financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions, my research, and my experience of more than 30 years as an independent investor. So, do your own research, do your own due diligence, and consult a financial advisor prior to making any major financial investment decisions. One more quick item. I'm going to kindly ask you to give us a like and consider subscribing to our channel here at Dividend Blasters at the end of the video and share this video with a friend or a family member. Okay, so what are these steps? These steps are these, and let me outline this again for you. I'm going to show you how to turn $5,000 into $1 million through minimal effort and minimal risk to you. Step one, I've identified three simple investments for you to select and invest in. Minimal amount, $5,000 split across these three. Two, you're going to drip 100%. Okay, what does that mean? That means every time a dividend is paid out in these investments, you're going to automatically reinvest it into your holdings. That's a way to grow your holdings, to build them up. Number three, you are going to continually invest funds into these three investments over the investment time horizon that I'm going to outline for you. It's not going to be a lot of money, it's going to be a minimal investment annually. And then step four, it's the best part. Do nothing. Do nothing. Let time work its magic. You know, Warren Buffett once said that the stock market is comprised of those who win and those who lose. Those who win are those who are patient. Those who lose are those who overtrade, and those who are impatient. Win. Be patient. Okay. Step one, invest in the market. So I will tell you this, that I've outlined two ETFs for you to consider investing in the market. The Vanguard S&P 500 ETF, or ticker symbol VOO. It mirrors the S&P 500 index. I've also outlined or identified the Vanguard Total Stock Market Index Fund. That basically reflects the performance of every single stock in the U.S. stock market, and this ticker symbol VTI. These are both fine. I will select VOO, but they're both fine. And I've identified them both for you to consider. The next category I want you to look at is investing in growth. Okay, I've identified two ETFs, Invesco QQQ Trust ETF, ticker symbol, not surprisingly, QQQ. And another alternative is the Vanguard Growth Index Fund ETF, ticker symbol VUG. These basically are two ETFs that invest in high growth, high tech stocks, typically. The one that I am showing preference towards here is QQQ. And then the last one is investing in dividend growth. That is part three of step one. And I've identified the Schwab US Dividend Equity ETF, or ticker symbol SCHD, and I've also identified Vanguard High Dividend Yield Index Fund ETF. I am going to focus on, for the rest of this video, SCHD, QQQ, and VOO. These are the three investments that I'm going to show you that you can invest an initial amount of $5,000 and turn it into $1 million. Next. So, a little bit background on our first of the three, VOO. It's an exchange traded fund. It's launched and managed by the Vanguard Group. They invest in stocks operating across diversified market sectors. They invest in growth and value stocks of large cap companies. They employ an indexing investment approach to track the performance of the S&P 500. This ETF was formed in August 31st, 1976. All right. Let's go a little deeper. They closed yesterday, July 21st at $419.87 a share. I really like that expense ratio of 0.03%. That means for every $10,000 you invest in this ETF, it costs $30 for them to manage. It's a quarterly dividend paying ETF. Dollarized, it's $6.20 of dividends paid out annually per share. That comes to a trending 12-month yield of 1.48%. They manage $336 billion in assets. This is a good sized, well established ETF. I like their top 10 holdings. You can see the one that is the most significant is Apple, followed by Microsoft, then Amazon, and then Nvidia, and then Alphabet or Google. And you can read them there, and you can see that this is heavy in technology. And then that is followed by healthcare, financials, and then consumer cyclical. This graphic shows you what the total return and the price return has been for VOO since 2010. Okay, this is as far back as Seeking Alpha will take us. So the reason why I want you to drip 100% is that you can see a difference in total return, okay, versus price return. Price return is just price appreciation. They're going to return 306%. Total return, that's when you're reinvesting your dividends, 421%, right? That's over 23 years. That is a different. Every little bit adds up, folks. All right. Second one, invest in growth. QQQ. Little background on QQQ. They are managed by Invesco Capital Management. They invest in stocks operating across multiple sectors: energy, real estate, materials, industrials, consumer discretionary, consumer staples, healthcare, IT, communication services, and utilities. They invest in growth and value stocks of large cap companies. It's like the previous one. They're going for the large caps. They track the performance. Now, unlike the previous one, which tracks the performance of the S&P 500, QQQ tracks the performance of the NASDAQ 100 index. They were formed on March 10th, 1999. They're a little bit younger than VOO. They're a little bit more tech heavy, and they are more closely aligned to NASDAQ. They closed yesterday, Friday, July 21st, at $383 a share. Expense ratio is a little bit more. It's 0.2%. The dividend rate, dollarized, is $2.15. So that trending 12-month yield is 0.56%. They pay out those dividends quarterly. They're a little bit smaller, but they're still good size. They're a little bit smaller than VOO. The assets under management are about 212 billion. That is a good size ETF. This is a very well established ETF. Top 10 holdings, and you're going to see a little bit of an overlap with VOO, but you see Apple and Microsoft are the top two, then Amazon, then Nvidia. Kind of similar. The allocations are going to be a little bit different. These are going to be a little bit more NASDAQ heavy. So then you have an Nvidia, then you see Meta Platforms, Tesla, Broadcom, and then you see the Alphabets, two different classes of stock. And then they have Pepsi. Well, that's interesting. Pepsi. You can also see the breakout by sector. And this is much heavier in technology. It's almost 50% in technology, followed by comms and then consumer cyclical. All right. Now, what you see here, now this is interesting. Price return is 589%. Total return, 685%. And again, and I've mentioned this in previous videos, total return is the same thing as price return plus dividends. So you can see again why I want you to reinvest those dividends. Okay, that is the difference between 589 and 685. So that is 96%. That is a nice chunk of change. Hard to see it in the graph, but you see it in the numbers. You want to drip, drip, drip as much as you can. That is going to accelerate the growth of your holdings. Last but not least, our last category, investing in dividend growth. The Schwab US Dividend Equity ETF, or SCHD. They are managed by Charles Schwab, and they are an exchange traded fund that invests in stocks operating across multiple sectors, like the previous energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, IT, communications services, and utility sectors. Kind of sounds the same, but it is different. Okay. It actually, you're going to see it is actually aligned to a different index. We'll get into that. They invest in growth and value stocks across companies of diversified market capitalization. So that's different. Not just the large caps, but mid caps, some small caps. They, and this is where it is a little different, invest in dividend paying stocks of companies. They track the performance of the Dow Jones US Dividend 100 Index. Okay, that's really different. Aha. They were formed in October 2011. Fascinating. All right. These guys are a little cheaper price wise. They closed yesterday, July 21st, $75.63 a share. That is a very competitive expense ratio, 0.06%. So they're a little bit more expensive than VOO. VOO is very cheap. They were 0.03. QQQ is more expensive. There's more administrative fee there, which it's still fine, the 0.2%, because you're going to get a nice return. Okay, it's a quarterly dividend paying ETF. The trending 12-month dividend rate dollarized is $2.60. The yield 3.44%. This is a smaller ETF. They're about $50 billion in assets, but they're much younger. But I will tell you this, they are probably the most popular ETF today because they have performed so well in the last 11 years. SCHD. Here's their top 10 holdings. Broadcom, well, that is a chip maker that's on the move. Home Depot, UPS. I'll tell you what, I have lots of shares in UPS and Broadcom, and I'm glad I do. Cisco Systems, Pepsi, Coke, AbbVie, the drug company, Amgen, the drug company, Texas Instruments, Chevron, the oil and gas company. Let's look at the breakdown by market sector. They're heavier in the industrial sectors, followed closely by financials and very closely by healthcare, then closely by consumer, defensive, and then technology. So it's a little bit different here. You have industrial, so you're going to basically see, defense, and you're going to see logistics like UPS. You're going to see Lockheed Martin in here if you go down below the top 10. You're going to see probably Raytheon as well. Financials, you're going to see some of the financial institutions. Healthcare, I mentioned AbbVie and Amgen. You're going to see a bunch of consumer stocks. So, this is a little bit more balanced, and they're chosen not by sector, but they're chosen by their ability to pay a growing dividend and a continuous dividend. And that's why this EFT is so popular. So let's take a look at their return, price return and total return. So for that max time horizon, price return is 191%. It's not bad. But total return is over 315%. That's the difference. And that's why I want you to drip 100%. Okay, because that is over 125% increase in your returns. You want to be dripping. Drip, drip, drip. All right, step 2. Aha, as I was saying, drip, drip, drip. You want to be dripping. Always be dripping. As you drip, you're building that dividend snowball. And it's going to be slow going in the beginning, but it will gain momentum. Step 3. continually invest, grow your holdings. Tell you what, you want to get on a strict budget as you do this, and you want to prioritize investing over maybe careless spending habits. You want to get disciplined. It's very, very important. You want to continually reinvest. Okay. So, in addition to reinvesting your dividends, you want to invest more into your holdings and split them across your three different holdings. You can allocate them any way you want. I would do it evenly. Um, and the reason why I'm not choosing one EFT or ETF over another is I want to diversify my risk. I want to invest in the broader market. I want to invest in growth ETFs and I want to invest in dividend ETFs. And that's why I'm doing this. So you want to be continually investing. And then, as I mentioned, do nothing. Let time work its magic. You need to let time take control. Okay, you do your thing, you're patient, and you let time do its thing. So, here's the scenario. What I'm going to show you is that you can take $5,000, split it three ways, and invest in these three different ETFs. Okay, so for instance, you may take $1,667 and invest that amount in VOO. And then every year, you should invest $2,000 a year. So that comes to about $166, $167 a month. You do that. Okay, it's not much. You can do it. There's a dividend tax rate, 15%. So even if you don't take a distribution, which you shouldn't, you should still drip, you're going to pay the tax. That initial dividend yield for VOO is about 1.52%. Based on our research, looking at the dividend growth rate, the CAGR for the last 10 years, we estimate conservatively an increase of about 6% a year. We're also estimating that the wider market would have a price appreciation rate of 5 years, and our time horizon it's going to be 30 years. Now you can vary that. If you don't want to do 30 years, do 20 years, do 15 years. I will show you the impact of time. Aha. So after 30 years, you're going to have $185,000. That's about a 200%, 201% return, annual return, 3.75%. You can see what your annual dividend income will be after 30 years. Your yield on cost is going to be almost 6%. So you can see the total dollar amount here. It's going to be right up here around almost 200,000. Here's the total dividend income I mentioned, and here's the yield on cost. So think about this: $186,000 from VOO. Remember, you're going to put $2,000 up front, and you're going to put $1,677 up front. Okay, it's $5,000 split three ways. And then you're going to do $167 every month or $2,000 a year. And $185,000. All right. And here is the table. You can look at this at your leisure, but I think the graph is more impactful. All right. That was part one. Part two, you're going to invest in QQQ. All right. You're going to drip 100%. You're going to start with $1,667 and you're going to put in $2,000 a year, which is about $167 a month. You're going to pay the 15% tax rate on those dividends, but you're going to drip 100% to grow those holdings. The initial dividend yield on QQQ is 0.57%. Our research from Seeking Alpha shows that the CAGR for the last 10 years is around 10%. And we're also showing that the annual share price appreciation would be approximately 10%. That's what history shows us. So now, you know what? That's no guarantee that's going to happen, but this is the best predictor we have. Our time horizon that we're looking at is 30 years. So what do we have after 30 years in QQQ? We're going to be approaching close to $400,000, $393,964. Total return, almost 539%. Average annual return, 6.38%. Look at that dividend income. At an annual rate, it's going to be over $2,200. Over 30 years, you're going to receive $18,000 in dividends that are going to be reinvested. Not too shabby. And here is the table, and you can look it up. You can see the details, and you can see the varying dollar amounts by year. And then let's go to our last one. We're going to also invest in SCHD. And this is a quarterly dividend paying ETF. And it is going to be, we're going to start at $1,667, just like the other two. And we're going to pay in $2,000 a year, which is about $167 a month. We're going to pay the dividend tax rate of 15%, but we're still going to drip 100%. The initial annual dividend yield on SCHD is 3.67%. Based on past CAGR performance of the dividend, we're expecting and projecting a 10% annual dividend increase for SCHD. We're also expecting, on average, annual price appreciation of 10%. Our time horizon is 30 years. Aha. Look what we got. $673,000 after 30 years. That's a total return of 992%. Average annual return, 8.29%. At the end of 30 years, we're going to be generating $25,000 in annual dividend income. Over the years, you're going to be dripping $170,000 back into your holdings just through those dividend payments. That is amazing yield on cost of 37%. What this should demonstrate here is the power of compound interest. Here is a table that shows you the dollars of the different years within the 30-year time horizon. You can vary it. If you don't want to do 30, do 20, do 15. That is up to you. But I'll tell you what, the longer you do it, the bigger it's going to be. And you know what? Here is a summary table that shows our initial investment of $5,000 and then our annual investment. We're going to do extra of $2,000 for each of these. Now, guess what? If you put more in, it's going to grow faster. If you start with more than 5,000 and split it, it's going to grow faster. That is totally up to you. But what I am demonstrating here is that you start with $5,000 and you split it across these three index ETFs, index fund ETFs, and you invest $2,000 in each of these every year, and you drip 100%. And we presume that we're going to get the same yield or the same CAGR, as well as the same price appreciation that the past has shown us. We're going to get approximately $1.25 million after 30 years. That is it, folks. I hope you found this to be informative and insightful. And I'm going to kindly ask if you would give us a like and consider subscribing to our channel here at Dividend Blasters and share this video with a friend or a family member. Until our next video, have a wonderful day and God bless.